Qantas Airways, Australia's flag carrier, is a global icon, renowned for safety, reliability, and a century-long legacy. Its flying kangaroo is synonymous with premium service and national pride. Qantas connects Australia to the world, operating a vast international network. But as the industry evolves, so does Qantas's strategy. Enter Jetstar Japan, a very different airline, born in 2012 as a low-cost carrier for budget travelers. Jetstar Japan was a joint venture, with Qantas as a founding partner, aiming to capture Japan's growing appetite for affordable air travel. For over a decade, Jetstar Japan offered a no-frills alternative at airports like Narita, helping Qantas compete in Asia's booming low-cost market. The partnership with Jetstar Japan was central to Qantas's Asian ambitions, leveraging local expertise from partners like Japan Airlines. But now, that chapter is closing. On February 3, 2026, Qantas announced it would sell its entire 33.32% stake in Jetstar Japan. This marks a major strategic shift, ending a long-standing partnership and raising questions about the future of both airlines. The move is more than a financial transaction. It's a rethinking of Qantas's global priorities. Why is Qantas stepping away from a market it once saw as crucial? What does this mean for Jetstar Japan and the broader aviation landscape? To understand, we need to look at the forces driving this decision. Qantas is charting a new course, and Jetstar Japan is about to enter a new era. The story of these two airlines is about to take a dramatic turn. Let's explore why. Qantas's decision to exit Jetstar Japan is a calculated strategic pivot. The airline is refocusing on its core strengths, the premium Qantas brand and its successful domestic low-cost arm, Jetstar Airways Australia, with a massive fleet renewal underway, including Project Sunrise, which will connect Australia directly to cities like New York and London. Qantas needs to concentrate resources at home. The international budget airline sector has proven volatile and low margin, with recent closures like Jetstar Asia and Singapore highlighting the risks. By selling its stake in Jetstar Japan, Qantas simplifies its business, reduces risk, and frees up capital for its Australian operations. The message is clear. Qantas's future lies in strengthening its domestic and long-haul premium services, not in expanding budget brands across Asia. This is a move towards stability and profitability, not speculation. The era of international Jetstar joint ventures is over. Qantas is doubling down on what it does best. The sale is about focus, simplification, and building a stronger foundation for the future. For Qantas, it's time to come home. For Jetstar Japan, it's a new beginning. Asia's aviation market is fiercely competitive and costly. Jetstar Japan entered a crowded field, battling legacy carriers and a surge of new low-cost rivals. High fuel and supplier costs, plus intense price wars, made profitability elusive. Qantas's experience in Singapore with Jetstar Asia showed just how tough the region can be. Too many airlines, too few passengers, and razor-thin margins. The joint venture model, once seen as a path to growth, proved complex and capital-intensive. Qantas learned that exporting the Jetstar brand across Asia was riskier than expected. The retreat from these ventures is an admission. The risks outweigh the rewards. For Qantas, the lesson is clear. Focus on home turf. Qantas is investing billions in a historic fleet renewal, reshaping its future with new, fuel-efficient aircraft. This requires capital and management focus, resources freed up by selling its Jetstar Japan stake. The Australian domestic market remains Qantas's profit engine, with both Qantas and Jetstar Airways dominating. Recent market softness makes it even more critical to focus on stimulating demand and optimizing operations at home. International Jetstar ventures, with their complex partnerships and unpredictable returns, no longer fit the strategy. For shareholders, simplification means more value and less risk. Qantas is preparing for a future where growth is harder to achieve. By shedding non-core assets, the airline becomes leaner and more agile. The sale of Jetstar Japan is a proactive move to de-risk the business. It's a disciplined decision, prioritizing long-term stability over speculative growth. Qantas is betting on what it knows best: Australia and premium long-haul travel. That's where its future lies. With Qantas gone, Jetstar Japan becomes fully Japanese-owned. Japan Airlines and Tokyo Century Corp will consolidate control, ensuring continuity and a new strategic direction. The airline will undergo a major rebranding, aiming to resonate more deeply with Japanese consumers. The goal: transform Jetstar Japan from a foreign transplant into a truly Japanese low-cost carrier. The Development Bank of Japan is set to join as a shareholder, providing financial stability and signaling government support. This backing will help the airline weather the transition and pursue growth. JAL's CEO, Mitsuko Totori, sees this as a chance for deeper integration with the JAL Group. Expect closer cooperation on routes, marketing, and loyalty programs. Jetstar Japan will become a core part of JAL's strategy to compete across all market segments. A new era, with a distinctly Japanese identity, is about to begin. Under JAL's leadership, Jetstar Japan is set for international expansion from its Narita base. The focus shifts from domestic to outbound leisure travel, targeting popular Asian destinations. The rebranded airline will act as a feeder for JAL's long-haul network, connecting passengers across Asia to Europe and North America. This synergy strengthens JAL's competitive edge, offering more travel options at different price points. Fleet growth is on the horizon, with new aircraft likely to support the expanded network. Backed by JAL and the Development Bank of Japan, the airline has the financial muscle for long-term investment. The vision transformed Jetstar Japan into a major regional low-cost carrier, challenging rivals and capturing new markets. The departure of Qantas is not an end, but a launchpad for ambitious Japanese-led growth. Jetstar Japan is poised to become a key player in Asia's low-cost airline scene. The next chapter starts now. For travelers, the transition brings new opportunities. In the short term, flights and bookings remain unaffected. Soon, passengers will see a new brand identity. Aircraft, website, and signage will reflect a Japanese focus. The biggest change: more international routes from Narita, offering budget-friendly options across Asia. Increased competition could mean lower fares and more choices for both Japanese and international travelers. Deeper integration with JAL may bring code shares, easier connections, and shared loyalty benefits. However, Qantas frequent flyers may lose the ability to earn or use points on Jetstar Japan. The direct link between the Australian and Japanese Jetstar brands will end, but broader alliance benefits remain. For most travelers, the future looks brighter and more connected. Qantas's exit signals a shift in airline strategy. Legacy carriers are rethinking complex multi-country ventures. The joint venture budget airline model is proving less profitable and more complicated than once believed. Other airline groups are watching closely, considering similar moves. In Japan, competition will intensify as Jetstar Japan, now fully integrated with JL, expands internationally. This puts pressure on rivals like ANA and Peach Aviation, sparking a new battle for market share. Narita Airport's role as a low-cost hub will grow, attracting more airlines and boosting the local economy. Investors have responded positively, seeing logic in both Qantas's simplification and JL's growth plans. The industry is entering a phase of consolidation and renewed focus on core strengths. Airlines are learning, sometimes less is more. Qantas's sale of Jetstar Japan marks a turning point for both airlines. Qantas is streamlining, investing in its core business, and preparing for a future built on stability and premium service. Jetstar Japan, under Japanese control, is set for rebranding and international growth, backed by JAL and the Development Bank of Japan. The competitive landscape in Japan and Asia will shift, with travelers benefiting from more options and lower fares. This move may inspire other airlines to refocus on their strengths and simplify their operations. February 3, 2026, will be remembered as the day two major airlines charted bold new courses. Qantas looks inward, while Japan Airlines looks outward, each seeking clearer skies ahead. The next era of aviation in the region begins now.